Episode 5. I solemnly swear to not put all my eggs in one basket, to not invest because I fear I'm missing out, to not buy high and sell low unless I really need to get rid of a bad egg, to not chase dividend yield, and I solemnly swear to not assume that what worked in the past will work in the future. Oh, come on, I still do all of these things. But these things don't come overnight, right? They call it lifelong learning for a reason. So without any further delay, Episode 5, Investing Principles, here we go. Welcome to Episode 5 of the Beyond MD podcast. It's our first episode on investing, finally. So today's episode is going to address the public market, stocks and bonds, whereas future episodes will dive into alternative investments, including private equity. What a crazy year it's been in the stock market, the fastest bear market and fastest recovery on record. This is new territory for everybody, and I think there are a lot of lessons to be learned. Today's interview was with Andrew Yu, who is the Director of Research and Portfolio Manager at Burgundy Asset Management. He's also a former analyst at Goldman Sachs. Before we get into that, I just want to take a chance to thank all the listeners for tuning into the podcast. I really appreciate it, and I hope the content has been working out for you. Remember, you can always reach out to me, call me, text me, Facebook, LinkedIn, beyondmdpodcast@gmail.com to get in touch about topics that you would like to hear about. I want to make sure the podcast is relevant for all of you. And if you have time or feel inclined, please feel free to leave a rating or review on the podcast because this helps give me feedback and it also helps to spread word about the podcast. Okay, I'm going to quickly go over some lessons I've learned investing through the pandemic. Let's keep it short and sweet. Number 1, diversification is key. This sounds really cliche, guys, but for me, and I think for most others, it's the only way forward. So let's just examine the market rally from end of March until the end of summer. What was happening? Well, basically the tech stocks and stay-at-home stocks were carrying the market forward. And thank God I own some of those stocks. But hold on a second. What was happening in the last 6 weeks? Well, we have a rotation into cyclicals, into the value stocks. So we have financials, industrials, energy starting to propel the market forward. And thank goodness I own some of those stocks as well. So to illustrate a point, I'll share my 4 biggest holdings. And this is not to boast. I think I made it very clear in previous episodes that I don't have a whole lot to boast about. So the big 4 are Amazon, Nvidia, Enbridge, and Canadian banks. That sounds like a random smorgasbord, but investing, that can be a good thing. That's diversification. I work really hard at that and I try to keep it that way. Now, my portfolio for the time being is 2/3 equities and 1/3 ETFs. I would like to see that change a little bit. I would like to see it 50-50. And I say this because ETFs are simply a great way to diversify and they take some of the risk off. Because I know that individual companies, they're influenced by more than just company fundamentals. A lot of it's market behavior and news in the sector. So if we have a good news day where there's something positive on the vaccine, I know that energy and Enbridge are going up. But if we hear the opposite, I know that that sector, including Enbridge, is going to take a bit of a beating. So I just like to take a bit of the risk off. Now, some people ask me, why do I choose to invest in individual companies? It's a very good question. First and foremost, though, I get a great deal of fulfillment out of this. I spend many hours a week reading up on my companies and seeking new opportunities. For me, it's just a great way to keep up with news, current events. I love to learn how good companies acquire, how they grow, how they innovate, and then also learn why certain companies don't succeed. And through this, I'm learning as much as I can, learning about industries that are hopefully going to thrive in the future, and that's where I want to put my money. So diversification is key, but that is not to say that some people do not succeed by holding only a few equities, a few names. I'll give you an example. I trained with a good friend of mine. He's a radiologist in Ohio, very financially savvy. And he basically decided that in the pandemic, he was going to day trade with Boeing. He showed me his trades. I can prove this for anyone who's interested, but he would basically put in about $350,000 at a time into Boeing on one day. And then he day traded for 6 weeks and he doubled his money. Listen, I love him to death and I'm really happy for him, but 99.9% of us would fail miserably even attempting this. This doesn't fit with my investing philosophy. I would be up all night. I don't do it. I don't advocate it. So diversify. Okay, lesson number 2. I'll take you back to another story. So this was around March 1st. I was at work and one of my colleagues and friends, he came running into my office. He said, listen, my advisor is driving me apeshit. The market is crashing, but he's telling me to hold on to all my stocks, buy more. I want to sell everything. What do you think? And I said, no, that's a terrible idea. Listen, you are not that much older than me. You have time left. Hold on to your stocks. And when things dip, buy more. Just hold on to it. And then he said, no, I'm going to sell now and then I'll rebuy when the market hits rock bottom. And I said, listen, you're not going to know when it hits rock bottom. Just gradually buy on the way down. Anyways, he left and then he came back to my office 30 minutes later telling me that he sold all of his stocks. Now, okay, if you have a short investment horizon and you need the money soon, maybe. But for most of us who are thinking medium to long term, obviously just buy and hold. Like if anybody tells you that they know where the market is going to be tomorrow, in the next month, in the next year, they are blowing smoke. The first question you should have for that individual is, what are you smoking? The second question might very well be, can I join you? Depending on how you like to roll. Anyways, the only thing I smoke is buy and hold. It's the only thing I know that works, and I'm going to continue to do it. Okay, lesson number 3. Sometimes it is really valuable, actually often it's really valuable to get multiple views on a stock or a sector. And I'll give you an example. I think a lot of us read the Globe and Mail. So in April, Gordon Pape released an article titled Hold 'em or Fold 'em. And in the Fold 'em section, he had stocks that he felt were not worthwhile holding in the pandemic. And these included companies like Sienna Senior Living and Extendicare that are focused on retirement homes, long-term care, all that. And he outlined his concerns. Basically, at that time, he was right in that most of the deaths happening in Ontario were happening in these facilities to elderly people. He was worried about the regulations that were going to hit the industry, and he was worried about rising costs. I mean, all valid concerns. But then less than 1 month later came a really interesting article in the Globe by the Contra guys, Ben Gallagher and Ben Stadelman, who also run a website called ContraTheHerd.com. Anyways, they countered and wrote specifically about Extendicare in this article and acknowledged that yes, while the costs are going to increase in the short to medium term, the fundamentals for the industry remain intact because there's always going to be a need for these facilities. This company continues to grow by acquiring more facilities, and also occupancy rates continue to remain high and will do so in the foreseeable future. So after getting these multiple views, I have to side with the Contra guys. Now, I'm not telling you to go and buy these companies, but I'm just saying it's nice to get multiple views on a topic. So there are a few other sources that I enjoy. One is called Dividend Stock Rocks, DSR. It's run by Mike Heroux. He's a DIY investor. And basically, he focuses on the dividend triangle. So he only buys a company if it shows continuous growth in revenue, earnings per share, and its dividend. I find his approach to be very logical. I quite enjoy it. And then David Zanoni, who basically just works a regular day job, but his stock picks crush the market, and he publishes once in a while in Seeking Alpha. And it's not only about his picks crushing the market. I just find his articles to be very thoughtful and a very objective overview of each company he's trying to assess. So maybe worth a look there too. So for today's interview, we're very lucky to have Andrew Yu, who is portfolio manager and the director of research at Burgundy Asset Management. He's been at the firm since 2013, and he's responsible for managing the firm's Canadian small cap fund. Now, in his role as research director, he trains and hires the team of 22 analysts. Prior to Burgundy, Andrew was at Goldman Sachs as an investment analyst, and he worked in their investment banking division. Andrew also serves as the vice chair of the North York General Foundation Board of Governors and as the vice chair of the foundation's investment committee. Like me, Andrew graduated from Queen's University. He was in commerce, I was in life science. He was top of his class. I, my friends, was not. So without further delay, here is our interview. Okay, Andrew, welcome to the podcast. Where does this podcast find you?
Well, I'm in my basement in my home in Leslieville. It's kind of my home gym that I've converted into an office. So that's where I am right now.
So Andrew, went through your CV, your resume. Obviously, you have a lot of experience. And one of the things I'm interested in knowing is, how was your experience at Goldman Sachs as an analyst?
Yeah, it was great. It was a really good place for me to start my career and learn the ropes. I started off there covering financial institutions, so worked on some insurance companies for a little while, and then I moved over to the natural resource side, covering mostly mining companies, and I learned a tremendous amount there. I think one of the most important things I learned during my time at Goldman is how to value companies, which is sort of a core skill set I think you sort of need to have to be an investor. Fantastic experience. I spent a few years there, and I was on the investment banking team, so I also got to see how deals are made, how company executives and boards make decisions. But decided I wanted to move over to be an investor full time, and so that's why I made the move to Burgundy almost 8 years ago.
Okay, and then how did your focus become small caps at Burgundy?
Yeah, serendipitously. I've been investing since I was in high school. I've always loved it, and so I sort of dabbled in small caps then. I really did not have an investment philosophy at the time. When I went to Queens, I joined the investment club. I covered tech, media, and telecom for most of my time there, and again, I sort of gravitated towards small caps. Made a big score on one small software company, and kind of was hooked on small caps there. And then when I graduated, I took my savings and I would invest it in the market, and I would always gravitate towards small caps as well with that. I got connected to my predecessor who hired me. His name's Alan McDonald. And I came in for the interview, and Alan, like most small cap people, just loves to talk about investment ideas. So he asked me, what's in your personal portfolio, and started going through it. And it turns out we had a ton of companies overlapping between what he owned and what I owned. And I sort of thought, this is going to be great. We're going to have a great, partnership. And so I joined the Canadian small cap team at Burgundy on that basis.
I was smiling a little bit earlier in your answer because you said you started dabbling in small caps in high school. Like, I am so far behind you. I mean, I wish I started a little bit earlier, but you're probably way ahead of the game. Good to see.
Well, I don't know about that, but my first couple weren't very good. I can tell you that much.
So, Andrew, you've had so much experience working at different firms. You've worked as an analyst, and, we DIY investors, we get a lot of different information. We see analyst upgrades, downgrades. I'm just curious, like, what in your mind separates a really strong analyst from maybe an average one?
I think the most important thing, whether you're an analyst or a portfolio manager or a do-it-yourself investor, is, or one of the most important characteristics, is the ability to be independent, to think differently than your peers and the consensus. And I think you'll read buy and sell recommendations, upgrades and downgrade recommendations from sell side analysts, and oftentimes those recommendations come too late. You know what I mean? A company is downgraded after the results and the earnings are poor, and you sort of say, well, of what use is that to me? It's no use at all. And the really outstanding analysts will make that call before earnings are poor. And that's a very uncomfortable thing to do, to put your neck out and say, this thing is about to go off the cliff. It hasn't yet. I'm putting a downgrade on it now. And those are the really outstanding analysts who have the courage to stand apart from others and do something uncomfortable.
Okay, interesting. So maybe we'll just dive into the bulk of the interview now. And one thing, we've obviously fastest kind of bear market and recovery we've ever seen, but I think a lot of us have kind of marveled at how swift the recovery has been. It essentially seems like in the markets, it's been a V-shaped recovery, but at many points, it seemed a little bit disconnected from the economy. Early on, we saw lockdowns, shutdowns, we saw skyrocketing unemployment. And to many of us, we were trying to put the pieces together. So when I try to dissect it, obviously none of this would have been happening if the Fed and Bank of Canada wasn't injecting the amount of money that they did. We also know markets tend to be forward-looking, and some of the big tech companies have shown us that they're probably really well positioned for the short, medium term in this work-from-home environment. And then also maybe a bit of wealth inequality. I think Goldman Sachs even published maybe in the fall of 2019 that 80 to 90% of stocks may be held by the top 10%. And then on top of that, we have low interest rates, low bond yields. Maybe this helps to explain the disconnect, but maybe you can elaborate a bit further and tell us why the markets are not necessarily the economy.
Yeah, I think you hit on most of the big points there, so I don't want to reiterate too many of them. But your last point, I think, is perhaps the most important, that the stock market is not the economy. And increasingly, I think that is the case. Many people, when they talk about the stock market, they're talking about the S&P 500, which is the index which measures the 500 largest companies in the United States, the world-leading companies. And that index increasingly does not look like the economy. And the reason for that is because the top handful of companies, which are now all technology companies, dominate that index. So the Google, Amazon, Facebook, etc., and even some of the smaller, large companies, NVIDIA, Salesforce, the other big tech companies. You look at that top of the list, it's equal to, I don't know what the exact numbers are, but the bottom 300, 400 companies. So the index increasingly looks like the big tech companies, and the big tech companies have been the beneficiaries of COVID and work from home. And so when you and I think of the economy, we think of local shops, we think of factories, we think of tangible economy, but the index that everyone's referencing, that's not what it represents. It increasingly represents technology. And the other thing I'll say is that, especially in the months of November and December this year, the market is pricing in the vaccine. As you said, it's forward-looking, and there's been a lot of positive vaccine announcements, and the market has, it seems at least, has priced in the recovery coming from those vaccines.
Okay, that makes a lot of sense. Now, I'm a pretty detail-oriented guy. I'm very hands-on. So what I did recently was I tracked returns of a few different ETFs. One kind of focused on value stocks, the other one focused on growth stocks. And when I look at returns going back starting from March 2009, kind of the bottom of the last recession, all the way until pre-pandemic, it seemed like the gap between value and growth was maybe somewhere around 50%. But then currently, we're in the middle of a pandemic, and then growth stocks have basically jumped way ahead, and the gap has now increased almost 90%. And I guess going forward, my question for you is, if the vaccine rollout goes according to plan, and we eventually, let's say, return to normal around mid-2021, do you see this kind of rotation where value stocks and cyclicals continue to catch up to growth and technology? Or do you feel that the way people invest now, whether it's retail investors, institutional investors, do people just tend to favor technology? Because if I go through like preferred holdings of a lot of hedge funds, it seems to be all tech stocks. So do you feel like value catches up, or is there a fundamental difference in philosophy in how people invest today?
Yeah, you're asking a huge question, and a really good question, and I think you've captured it really well. This has been the worst decade for value investing, I think, ever. I read an article recently that this year is the worst year for value investing ever. So for sure, the valuation difference between a growth stock and a value stock today is extremely wide, perhaps the widest in history. And so I think naturally people ask that, well, when is this rotation going to happen? And you saw some of it happen in the last 6 weeks or so since the vaccines have come out. But I don't think it's as simple as saying all the growth stocks are going to go down and all the value stocks are going to go up. I think it is. It's just a more nuanced thing. If you overly simplistically say there's growth and there's value, I think in some cases there's a lot of growth stocks which are hugely overvalued, where COVID has given them some additional acceleration in the fundamentals of the business, but the valuations have dramatically overshot that fundamental business change, and there's going to be some casualties from there for sure. And I don't want to pick on it because I think it's they're doing some remarkable things, but like Tesla is one of the poster childs of this, right? It's a $600 billion market capitalization company. It's bigger than all of the other major automakers combined. It sells a tiny fraction of the number of cars, and their competitors are inventing electric cars to compete with them. But it's a growth stock, and it's sort of in that category. On the other hand, I think there are some other growth companies where the valuations are high, but they're very, very good businesses, and the growth runway is really long, and so it's not so crazy, and they may not see that big decline. In the value category, I think it's the same. I think in value, if you look at all the cheapest companies in there today, cheapest companies in the market today, a very large fraction of them are businesses in secular decline. And COVID would have accelerated that secular decline. And so do I think those ones that are secular decline businesses will, have a big recovery and recover to pre-COVID levels? I don't think that's necessarily the case. So I do think there's going to be some losers out of growth that have been flying along with the legitimate winners. And I think that rotation has started. But I don't think it's as simple as saying everything in growth is going to go down and everything in value is going to go up. I think it's just a lot more nuanced than that.
Okay, I think that's sounds like a really reasonable assessment. I think like COVID has definitely changed the landscape, and like you say, there's going to be winners and losers. And I knew Tesla was going to come up because everyone's talking about Tesla. I mean, it just seems like it's going off with runway, and there's no end in sight.
Yeah.
Okay, that brings me to my next question, and that is of valuation. So, some people are very concerned about the valuation of the market. It could be with any metric that you use, whether it's the PE or the CAPE. I don't want to get into too many details there, but I guess my question regarding value is there's probably a bit of a spectrum. Some people on one spectrum say, okay, the market is way too expensive. But then other people say, well, hold on now. Part of this buildup in the market has been, like you said, these good technology companies that are very sound businesses, and they're well positioned in a COVID and post-COVID world. And then also there was a recent interesting article in the Globe and Mail where I think Robert Shiller, who's a prominent economist, he said, well, listen, stocks are really, really appealing right now relative to the bond yields. And that gap, that difference in appeal factor is maybe at an all-time high. And we're also in a very low interest rate environment. So, hey, listen, the valuation of stocks where they're at right now, it makes sense. So that's, I guess the other end of the spectrum. I'm wondering, where do you fall on that spectrum with regards to valuation?
Yeah, I think your last point is the right one. I think that you want to be invested. You want to see your wealth compound, and if you're going to be invested, you have a limited number of options. And I think that article is correct. I mean, equity valuations are high, as you mentioned. The price to earnings multiple on most indices is pretty high, but when you invert it, so you get what's called an earnings yield. So, for example, if the S&P 500 is 20 times earnings, the yield on it is 5%. When you compare that to what you get on a government bond, which might be 1%, it looks actually quite appealing. And so I think that's just an important thing to keep in mind, is that people look at these price to earnings charts over time, and it certainly looks like things are expensive now, and they are. But if you look at the earnings yield spread compared to the government bond yields, it's actually pretty attractive on a relative basis. So I guess the message is, if you want to be invested, equities compared to bonds still actually offer better valuations. So I think that's just an important nuance, that people look at those charts and say, well, I can't invest, I'm buying at the top. But if you want to be invested, you're also investing at the top if you invest in bonds, as an example.
Fair enough. And I think earlier in the pandemic, even Buffett said, listen, stocks they're really appealing to bonds. So I think a lot of people share that sentiment. So like on bonds, I had a conversation with another portfolio manager. This was earlier in the pandemic, and he told me verbatim, he said, Yatin, you are young, you can tolerate risk. Do not waste your time with bonds. Bonds are for old people. He literally said that to me. What do you make of that statement for someone who has like a medium to long-term investment horizon?
I think there's certainly an argument for that. I think there's a few things. So I think bonds. There's three reasons to own bonds. One reason is to get the coupon, right? To get the yield. The second reason is because it gives you an asset that moves inversely to equities, and if you have the wherewithal to use it in a moment of crisis, it can be very valuable. So, for example, earlier this year in March, when the equity market was collapsing, bonds held up and government bonds increased in value. And so if you had the ability to say, okay, I'm going to sell my bonds at that point and buy equities and rotate, it actually is a very useful counter-cyclical tool. And then the final reason to own bonds is if you're really worried about deflation. If you think that the world is going to go into a deflationary trap like Japan has at various points over the last 20 years, bonds will perform. As a general rule, bonds will probably do better than stocks because companies have a very difficult time generating earnings growth in a deflationary environment. So there's still a place for bonds. I do think, though, that if you're young and you have a high risk tolerance, your allocation to bonds should be modest. If you have a very long time horizon and you can cope with volatility, you should have the vast majority of your wealth in equities.
Many listeners of the podcast, they are DIY investors. And I'll give you a scenario. Let's take somebody who's investing on their own and they want to put in about 2 to 3 hours a week reading up on companies, news updates, earnings. My question is, what do you advise for that individual? Do you tell that individual, okay, you're better off just putting your money into a bunch of ETFs? Because my understanding is that even a lot of people who breathe stocks and bonds every day, it can be challenging to beat the market. Or do you say, listen, it's totally reasonable to have a mix of ETFs and a mix of individual stocks? What's your just overall advice?
Yeah, I think it depends on how much time you have. And I think if you have an hour or two, I honestly don't think that's enough time to do individual stock picking. Like it is a taxing, very labor intensive job. So I think if you have an hour or two, I think you are better off being in ETFs, unless you have a situation where you have followed that company for a really long time and you know it really well. Then you might have a handful of those, but to be an active stock picker with a relatively diversified portfolio in an hour or two, I don't think it makes sense. I think you're better off being in ETFs.
Let's say you have a stubborn DIY investor, sometimes like myself. Like I tend to have, I guess, a mix of ETFs and some like big blue chip names. But if somebody is going to go ahead and like select some good companies, if in order to ensure that that individual is diversified and at the same time not overwhelming themselves, because I mean, to keep up with 20 companies, that's a lot of time and effort. So what kind of ballpark number of stocks do you suggest that one needs to be fully diversified, but at the same time not overwhelm themselves? Is there a kind of a number?
Well, I think it depends upon how much of your wealth is allocated to individual stocks compared to ETFs. But if you have most of your wealth in the index, but then you have a smaller component that's in individual stocks, you don't have to have that many of them, 5, 10. You don't need to have that many as long as you've got some diversification outside of it.
Okay, fair enough. And like if someone's going to go ahead and try to pick stocks, do you suggest maybe stay away from small caps? I know small caps are your interest. I find them very fascinating. I mean, I wish we had more time to talk about them today, but do you generally say, hey, listen, stick to the blue chips and forget the small caps? Any advice there?
So I have a few thoughts here. I think that some of the advantages of small caps, one of them is that they're easier to analyze, right? Large multinational companies often, not always, but often have many, many product lines. They're generally more complex. Small companies, it's usually easier to get to the root of what they do. They might have 1 or 2 products or business lines. And so that's advantageous from a pure time and due diligence perspective. The second thing about small caps is that they're much more likely to take a call from you. And I think that's also a benefit. If you're an individual investor and you call a company that has a market capitalization of 100 million, if you email their CFO, there is a chance they're going to email you back and say, we'll spend an hour with you on the phone. Because they won't get that much interest from professional investors. And so you might actually be able to call the CFO and spend an hour with them and get information that you would never get that. Like if you try to email the CFO of Facebook, you're not going to get a response. So I think those are advantages of investing in small caps. Now, one of the disadvantages is you need to be able to cope with more volatility. Small caps are more volatile. And so if you've got that risk tolerance, I think it can make sense there. The one final point I'll just make, though, in do-it-yourself investing, is that you should really try your hardest to stick to companies where you really understand what they do. And that sounds so obvious, but there's this guy wrote this book, Philip Fisher. He wrote a book called Common Stocks, Uncommon Profits. Anyway, and he makes fun of the fact that you'll see people who are in the oil business buying pharmaceutical companies, and you'll see doctors buying oil stocks. And you're like, why would you do that? I mean, if the listeners on this podcast are in the healthcare business, you are way better equipped to analyze a healthcare company than I am. You should use that to your advantage. You're way better equipped to figure out if a diagnostic imaging chain is well run than I am. So I would just say staying within circles of competence, which is something that Warren Buffett writes about a lot, is a really important thing.
Yeah, that's a really interesting perspective. I think for sure, like you said, people working in healthcare can maybe use to their advantage. Now, maybe a more simple question. Let's say, scenario here, you have $100,000 that you want to invest. Do you go ahead and put it all in lump sum? I know some people have had challenges doing that given the volatility of the market in the pandemic, or do you dollar cost average? What's your approach here?
Yeah, so I think what we tell our clients is that it's best to be invested, and it's not a good thing to try to time the market. No one can do it. Anybody who tells you they can time the market on a week-to-week basis is lying to you to try to get your money. So don't believe them. So I do think that one of the best things to do is to put it into the market and leave it and give it to someone you trust. Put it into the market and walk away and check it once a year. Honestly, I do think that is one of the best things you can do. But this year has been very volatile. The market, in my market, went down over 40% in March. It's now up on the year. It's been very, very volatile. And a lot of people, in both directions, up and down, say, I just don't have the courage to put it all in at once. So what we tell our clients to do, if you really feel strongly about that, is to do what you're suggesting, dollar cost averaging. We usually say break the amount into 5 components and do one fifth per month. And if the market runs during that time, great. You've still participated a little bit. And if the market declines during that time, great. You're going to buy some of it more cheaply.
Okay, that's very reasonable. I mean, I can tell you, speaking to volatility, my TFSA had many small caps in it, and I almost had a heart attack. It was 50 to 55% down because of these small caps, but then stayed invested. The small caps rallied like crazy. Now, okay, let's maybe just touch on evaluating a company. I mean, yeah. I'm obviously a novice at this. Some of the things that I look at, first, big picture industry. Does the big picture make sense to me? I want to make sure that growth and revenue and profit margins is consistent. I'm a bit defensive, so I try to, make sure a company is not in an insurmountable amount of debt, looking obviously for a reasonable valuation. And if it's a dividend payer, I look for some things like consistent growth, a reasonable payout ratio, and then even insider activity if insiders are buying. But I want to hear kind of your synopsis on kind of how to roughly evaluate a company if you are looking to pick a stock.
I think you've really nailed it. I think many of those factors you mentioned are the exact same things that professionals like myself who are quality value investors. Those are many of the same things that we look for. So I think you've given a really good list there. I think there's a famous investor, Charlie Munger, who's Warren Buffett's counterpart. And I really like how he phrases it. He says, investing is like looking for a really good sled ride. You look for a long hill where you've got a lot of runway. And it's the same in companies. You're looking for a business that's got a really long runway to earn high returns on capital or reinvest its earnings at a very high rate and has a long runway to do that. And so I think what you're saying in your first comment there about revenue growth and earnings consistency is exactly that. The only thing I would add to that is to try to quantify how much runway does it have ahead of it? How much of the market is left for it to win market share in, as an example, or how penetrated is the product into the market, those kinds of things. But I think you've given a really good list. The only other thing I would add, and again, I think you have an ability to do this in small caps as a do-it-yourself to some extent, is your evaluation of the quality of the management team. And your last point there was getting at it, I think, which is there insider buying activity, which is a really good indicator. Do they believe in what they're doing? But if you get on the phone with a management team, you get a sense for them. You get a sense for their business ethics. You get a sense for the conviction with which they believe in their business plan. You get a sense for how do they have their finger on the pulse of the business? Do they speak to customers regularly? Those kinds of things. And that makes a big difference. So the only other point I might add is the quality of the management team is really important.
Okay, so those are kind of the fundamentals that we kind of assess when we're looking to maybe pick a company to invest in. And I'm wondering, Andrew, you live and breathe this stuff every day, but how often do technicals, and there's so many different technical metrics, but how often do technicals play a role in making your decision of whether to invest? And at times, I'm curious, did technicals ever outweigh the fundamentals when you're deciding to buy?
Yeah, so for our investment firm, we're fundamental only. So we do fundamental analysis and make our investment decisions based upon that. I guess, if you wanted to think about our technical analysis, what we try to do is we try to set target prices for our companies, if you will. So at this price, this company on our watch list becomes viable. It's going to earn the rate of return we want to earn. And we try to stick to that and use that as a signal for when to buy what's on our watch list. But in terms of other technical indicators, moving average crossovers and relative strength indices, we don't use any of those metrics. Other firms do and do with success, but it's just not our strategy. I find that you tend to find more people using those kinds of indicators in more complex markets, commodities, futures markets, those kinds of things.
Okay, perfect. And Andrew, dividend investing. Dividends, obviously there's certain things we try to look for to ensure that this dividend is strong and sustainable. But can you maybe touch on some of the factors or specific items that you would look for when deciding whether a dividend stock might be a good one to invest in?
Yeah, definitely. Well, I think there's a couple things to keep in mind. So one trap that people will fall into is just buying the thing that has the highest dividend yield, right? And it's very tempting. Like, look at this yield I get. I get 7, 8, 9, 10. It must, what a great deal. And sometimes that can be the case, but the market is more efficient than you think. There's a reason that it's trading at an 8 or a 9 or a 10% dividend yield. There's probably something wrong with it that makes it risky. And it's kind of your job as an analyst to figure out, is that risk worth taking? The most obvious one you can do is check the payout ratio. Is it over distributing earnings? Is it paying out more cash flow than it has? So that would be one thing you can look for. A second thing would be, which is a related thing, which you see all the time, is companies that come up with the cash to pay their dividends by drawing bank lines or borrowing effectively to pay dividends. These kinds of things are problematic. So I would just say that. And then the third thing that I would say is that if sometimes what you'll find is a high dividend yield company where the payout ratio is low on recent earnings, but where the earning stability is poor. So if you have a business that's wildly cyclical, I don't know, like auto manufacturers, you might get a nice dividend today, but tomorrow the earnings go away and they cut the dividend, even though on today's earnings, the payout ratio looked okay. So consistency of earnings and a low payout ratio makes the likelihood of a dividend cut much, much lower, which is what you want to avoid.
Okay, perfect. And in terms of payout ratio, would you say that like 40 to 80%, is that reasonable, or does it kind of depend on the sector?
It depends on the sector, but I think that's reasonable. I think the higher the ratio, the more confidence you have to have in the stability of the business. So if the ratio is 80 or 90 or 100%, that could be okay as long as you believe that those earnings are bulletproof. And if it's 40%, that's a lot better because it gives the company wiggle room. If the earnings are poor next year, they're less likely to have to cut the dividend.
Okay, I'm going to give you a question with some multiple choice answers. I want you to just select the best answer here. What is the most common mistake that you see among DIY investors? Is it A, lack of diversification, B, thinking what worked in the past will work in the future? Is it C, chasing dividend yield, D, reacting emotionally on fear of missing out, buying high and selling low, or E, is it something else?
I think the answer is D. And I think that I think that answer actually applies to do-it-yourself investors and professional investors. Perhaps professional investors are a little bit better at mastering their emotions, but we're not designed to be investors. We're just not. We are programmed by evolution to have certain fight or flight responses, and in a time of crisis, our amygdala fires and it takes over our brain's ability to rationally think and to think long term. And that happens whether you're a do-it-yourself investor or you're a professional investor. I think the difference is just that professionals try to train themselves to act differently during a moment of crisis. This year is perhaps the perfect example. When was the best time to buy stocks this year? March 23rd. That was the bottom of the equity market. And in my market, in small caps, the market was down over 40%. I mean, it was gut wrenching. It was really, really, it was crazy. And, I think a lot of people, professionals and do-it-yourself investors combined, were fearful, right? And in that moment, people panic and a lot of people hit the sell button. It's really easy to hit the sell button in March of 2020 when, you're coming home and every day on television, there's something about how the world's ending and unemployment's 25% and retail sales are down 40%. And it's very easy to just hit the sell button. And a lot of people did. And I think that is the killer for investors, do-it-yourself or professionals. My founder of our firm, a guy named Tony Arrow, he has a great saying. He says that when you're walking the ticket over to the trade desk and your hand is shaking, you're about to make a good investment, and because you're so afraid. And it's a moment of maximum fear is when the greatest opportunities emerge. And I think that is something that you, as a professional, have to train your mind to think like. When I feel the least safe is that when things are actually the safest because I'm buying things the cheapest. And I just think a lot of do-it-yourself investors are prone to hitting sell when things are really scary.
I think that's a great point. And, I even heard Jim Cramer say that, it can take a lot of fortitude to buy things when they're dipping hard, but that's when people are fearful. And I think that's the time to go in. And, I have another friend who's also told me, and I know I'm an emotional guy. I react to a lot of stuff. And he said, listen, you need to be less emotional with your decisions. You almost need to be robotic. You make the purchase, it's done, forget about it. Don't watch the price. You're in the market. Yeah. So those are kind of the things I also keep in mind, when I'm making my decisions. Okay, let's just S&P 500. I think over the last 10 years, I was tracking the returns, something like 11.8 to 12%
annualized,
which makes it a pretty good decade. And now I keep hearing people are writing pieces in the news that don't expect the same kind of returns over the next decade. Maybe this is just to generate attention. We know that fear sells, but one of the concerns that a lot of people have is, well, there's been a lot of monetary stimulus, a lot of money being poured into the economy, and eventually some of this is going to have to be paid back. I guess, are you concerned that what's happened during COVID is going to hamper returns in the next 5 to 10 years?
Yeah, well, I think there's a few factors you pointed out there. So one of them is that interest rates were lowered during COVID, right at the beginning, cut to near zero or zero across the developed world. And as you mentioned earlier, that has the effect of increasing equity valuations. People are willing to pay more for a dollar of earnings because the alternative in owning bonds is just much less attractive. So I think to some extent, yes, I think lower interest rates pulled forward returns, and you're not going to have that same lever on the other side of COVID. I mean, interest rates are already zero. Now that's famous last words because interest rates are negative in many parts of Europe, but you don't have the same monetary levers to get that pull forward in equity valuations that we've had this year. So that is one factor for sure. And then the other factor you mentioned is repaying what we've spent this year. I mean, this has been an unbelievable year in fiscal stimulus, certainly unprecedented. There's different estimates, but most people kind of think that this will add about 20% of GDP to national debt, which is a very big step up. In Canada, it's, $300-400 billion. In the US, it's in the trillions. And I think one of the other fears is that we're going to get a big increase in taxes, and that's going to stifle economic growth. And I think that's also a risk. You have higher valuations with less monetary levers, and you have potentially changes in tax policy that could impact economic growth too. So I personally think prospective returns are not as good as they were over the last 10 years, and that repeating what has happened in the S&P 500 is very unlikely. Now, I do want to caveat this, though, by saying that the S&P 500 has been the place to be for the last decade, right? Like the S&P 500 stands alone in the world as one of the best places you could have been. There are other markets that are less expensive and have had less of a good run. But most people, when these statistics get cited, they're looking at the S&P 500. And so there's a general sense that everything is really expensive. I don't think that's the case. There's still pockets of things that are cheap, but certainly in the U.S. large cap market, it's been a great run, no doubt.
And, for me, this is kind of a good segue into looking beyond our borders. And I'm going to bring up a quote that I heard on a podcast. So it's on the Prof G show, which is run by Prof Galloway. So he's a professor at NYU. a very insightful podcast. And he recently mentioned a quote, and he said that the greatest return on investment is basically a healthy, productive worker who is age 30 or under. And then I started to think about that quote, and I started to dig up, just demographic statistics. And I'll just bring up an example. So India, for example, I know people may not live as long in India, but the average age in the country is well under 30. I think it's between 26 and 28. So we know there are countries like India that have a very young labor force. So with that in mind, I mean, some people think that in putting your money into places like this may be a catalyst for higher returns. So thinking that, okay, if the S&P 500 is not going to repeat its performance over the next 10 years, we maybe need to look elsewhere. So I guess with this in mind, do you kind of share this view that there are other places to look beyond our borders, and maybe just discuss the role of equities, ETFs outside of North America in the portfolio?
Yeah, definitely. A lot of good questions in there. So, I'll start off by saying actually that I don't even think you can lump North America together. Canada has actually dramatically underperformed the United States. So Canada isn't as expensive as the United States is. I mean, we have Shopify and we have a handful of other expensive technology companies which skew up the valuation of the index if you want to look at it that way. But there's still a lot of value actually in Canada. So, but I think what you're asking is like outside of the U.S., what is there? And you raised the point of India, which is a really interesting one. And I'll get to your question about using ETFs in a moment. But India is fascinating. So India, until 2 or 3 years ago, traded at a very expensive valuation, very, very expensive. The market had priced in that demographic dividend that you're mentioning. But India went through a financial crisis starting a couple of years ago. There were actually bank bailouts, emergency loans for banks. Like it was a lot like the financial crisis in the United States. You just didn't hear very much about it. And then COVID hit. And so particularly in small caps in India and mid cap stocks, there's actually there's some value there now. And that demographic tailwind hasn't gone away. So India is actually somewhat interesting. I mean, just as, one data point to tell you how expensive things were, because my firm invests there, Unilever India, which is like the Unilever sub of that operates in India, consumer products company, 50 times earnings before that financial crisis, like really expensive. Some of those companies are still very expensive in India, but there's certainly a layer of companies now that have gone on sale. So on the question of investing outside of North America using ETFs, I think that really depends upon what market you're talking about. I'm not here to bash ETFs because I actually think they have a place, even though I work at an active management firm. In a place like the US, ETFs are a good thing to invest in because the quality of the index is high. And you have to just remember that an ETF tracks an index. And you have to objectively look at that index and ask yourself, do I want to own what's in that index? And so in the US, the S&P 500, great group of companies, right? I mean, sure, there's going to be some bombs in there, but generally speaking, very high quality group of companies. If you take an emerging market ETF index, the MSCI Emerging Market Index, and you look at what's in it, the quality of it is dramatically lower than what you find in the S&P 500. There's a lot of state-owned enterprises. There's a lot of banks. There's a lot of heavy industrial companies. It doesn't look like what you find in the S&P 500. And so it's a tough question to answer because you have the least familiarity with investing in a place like India. But investing in a place like India or China or elsewhere, you're much better off not using an ETF because the quality of the index is lower.
Okay, I think that's really useful information. I guess one way people like to bash ETFs is that they say, well, it's a large number of companies. You're going to get some poor quality companies, but as you mentioned, SP 500 generally much higher quality. So thanks for that, Andrew. Okay, let's just moving on to the end stage of the interview. So obviously there are some interesting sectors that are catching our eye. I think some investing themes for the future maybe. So when I think about it, I'm looking at the cloud space, work from home, e-commerce. I think obviously, Amazon. These companies are really well positioned. People talk about fintech all the time, renewable energy. These are the common ones I hear about. I'm wondering, what investing themes for the future kind of catch your eye going forward coming out of COVID?
Well, I think you've mentioned a number of them. If I take a few of the ones that you just mentioned, I mean, there's different ways to invest in these companies or these themes, and I think that's one nuance. Is for example, the cloud. I think everyone thinks, well, to invest in the cloud, you have to own Amazon, right? They have AWS, the number one cloud player in the world, and if you're a value investor, it can be difficult to own Amazon because it doesn't really generate any earnings. But there's other ways to invest in these sectors. So I would just say that that's one thing, that these trends are huge, and that if you're creative, you can find ways to invest in them that are not the ones that typically come to mind. On cloud computing, I mean, obviously there's the Microsofts of the world, but there's also a huge ecosystem of service providers who help companies get onto the cloud. I own one of them, and this sector is growing very, very quickly, but the valuations are not that high. They're nothing like what Microsoft and Amazon trade at. E-commerce is similar, right? I mean, Amazon has been the beneficiary of the shift toward e-commerce, but there's other players that do it. There's software companies that help companies get online and fulfill, click and collect and what have you. And we own one of those too. So I think there are these trends you mentioned are the right ones, and I think you just need to be creative about how you get at them. And then I think the other thing to watch for coming out of COVID, I think you have to ask, when COVID hits, it changes a lot of things, right? And people start to think short term. Going back to what I said earlier, when you're in a fight or flight mode, you don't think long term, you think sort of short term, and that same phenomenon happens to investing. And when you think about the losers from COVID, there's two buckets of them. There are the companies where COVID has permanently impaired their business model, where COVID has created a secular trend which is not going away, and which will be a headwind ongoing. And then there are other companies where COVID has temporarily impacted their businesses. And once this is over, you can have a fair bit of conviction that the business is going to return. A good example of that, in my opinion, is hospitality. I think that people want to travel and they want to be entertained. And that entire sector has been left for dead through COVID. Obviously in the last couple of months, it's had a bit of a rebound, but it's still very beaten up, at least in my small cap universe. And that doesn't make sense to me. I think coming out of COVID, there's going to be more demand for these services than there were before because there's a lot of pent up demand. And so I think that's the other thing to sort of think about is there's the winners from COVID, e-commerce, cloud computing, et cetera. And then there's the temporary losers. And the temporary losers are also interesting. The ones you want to avoid are the permanent losers.
Yeah, no, I agree with you. I think there are some really appealing temporary losers out there. I listened to a podcast recently too, and the hosts were kind of divided on whether COVID is going to change the way we think and act over the next 2-3 years versus is North America and the rest of the world just going to return to basically, partying mid-2021? Is it going to be a giant rave across North America? And you know what? I think that people need to travel. People need to return to that kind of normalcy. So I agree with hospitality for sure. A temporary loser, but I think some gains to be had.
I'll just raise one point there. And, I'm lucky because my firm invests in China, and we have 2 analysts who are dedicated to covering China. And it's fascinating to hear from them what is happening in China because they're way ahead of us in the recovery, right? And there are parties in China, clubs are going again in China, miles driven, as a crude measure of people being out and about, almost back to where it was before COVID. You look at some of the numbers from there and you sort of think to yourself, well, it seems to me pretty likely that life goes back to relatively close to what it was before, at least in some areas.
And you know what? Speaking to China and Asia, I think in their short to medium term, to me, honestly looks very promising because I don't know how they did it, whether it was just contact tracing or more testing. They just seem to handle the pandemic, I think, really, really well. So maybe, like you said, ahead of us there. So I know I'm not allowed to ask you for specific company predictions, but I'm going to ask you for one prediction. Next year, October 2021, does homecoming happen at Queen's again? And are you going to go back?
That's a great question. I don't think so, or it might. I don't know. I don't think it will happen. I'm just not sure if I was Queen's that I would risk running an event of that size when you have, generally speaking, a lot of older alumni come back who might be higher risk. I'm just not sure I would do it if I was in charge of Queen's. But I don't think that means I think most of the population will probably be vaccinated by then. But I if I was the dean, I just wouldn't do it.
We're all secretly hoping for homecoming to happen again. I mean, I can't wait to go back, but in due time. Listen, this was really, really just engaging conversation. I think you provided a lot of useful info. You obviously have a lot of experience, and thanks for taking the time to share that with us. It was great to have you on.
Well, thank you very much for having me. It was a pleasure being on and great to connect with you.
So there's the interview with Andrew Yu. I hope you enjoyed it. So when it comes to investing, stay diversified, stay invested, stay disciplined, and read and learn as much as you can. And if there does happen to be a Santa Claus rally in the stock market this year, well, I hope you are not on the naughty list. If you like what you're hearing, feel free to subscribe, download, and spread the word. Until next time, stay safe, everyone, and stay savvy.